Welcome to SIRA MCQ YouTube channel. Today we discuss advanced level A-level accounting paper 2024 question number 30. This is related to long-term investment. What are the requirements they request? Look here. Requirement is there. Which of the following statements are correct? We find the correct statements in relation to this project. There is three statements there. This is the information. Look here. A firm considering a new project to invest a machine with useful lifetime is 5 years. Okay. The estimated cost of this machine is 1 million. Look here, we can schedule it. This is, how can we calculate this is estimated cash inflow and outflow sheet. This is 1000, no? Rupees 1000. This is the years 0, 1, 2, 3, 4, 5. There is a cost is incurred. There is 1000 outflow. There is a cost of the new machine. Next one. They said the annual net cash inflows 200 is expected from this project. The annual means each year 200 net cash inflow. Therefore, we can identify, this is the final result of this schedule. The annual cash inflow means annually. Net cash inflow is 200 for every year without 0 year. Okay, 0 year is 1000 outflow. This is the estimated net cash inflow. So net cash flow, no? Cash flow. This is the estimated net cash flow. This is the schedule. Okay, next one is the expected rate of return of the project is 10%. Don't think about this. Firstly, expected rate of return means the investor expects 10% benefit from this project. The 10% benefit means interest rate. Why I said that? Look here. There is an investor, he wants 1 rupee to produce. Okay, 1 rupee for investment. Therefore, this 1 rupee coin was carried from a bank loan. Okay, this is the bank loan is 1 rupee. After that, bank collect 10% interest on this loan. Okay, therefore the investor after 1 year he find 1 rupee and interest rate of that interest rate is 10% for 1 rupee is 0.1. 0 is 10 cents. Okay, after that the owner or investor find 1 rupee and 10 cents for give to the bank. Therefore, every owner, every investor using this bank loan, and we assume that as bank loan, and after that, after 1 year, he want 10% benefit, 10% interest or 10% profit. There is a profit or benefit from this project. Therefore, this is the word is word is expected rate of return. No? The expected rate of return means there is a return he must collect from the customers benefit or profit to pay the interest. This is a 10% interest is expected rate of return to pay the interest. Therefore, the expected rate of return, I assume there is interest. Okay. Therefore, this is the interest rate. No, net present value NPV of the project is negative. We can clearly identify. Look here. NPV was calculated after discount multiplying discount factor. No, the net cash flows are 200 is 1000. The cash inflows are 1000 is equal to 1000. After the multiplying the discount factors, these cash flows are reducing. Why? Look here. This is the discount factors. No, discount factors, I assume 10% is 1 multiplied by 0.9, 0.8, 0.7, 0.6, 0.5. After the multiplying, we can find the present values. How can we find it? 120 multiplied by 200, 160, 140, 120 and 100. This 1000 is there multiplied by 1. No? Therefore, this is the present value 500, 500 and 700. Okay, 500 and 600 and 700. This is the outflow, this is only inflow. Net present value is 300 outflow. Okay, this is net present value is minus. We can already find it. They said that. Okay, next one, this is the statements there. Look here. The present value of total future net cash inflows, the present value of total future net cash inflows of the project, this project is lower than initial investment. Look here. Present value of total future net cash inflows of the project. Present value of total future net cash inflows. Look here. This is the present value. No, present values. Okay, present value. This is the current present value. This is the initial investment. The future cash inflows present values are present value of future cash inflows are there. The present value of future cash inflows are 700. Currently initial investment is 1000. Look here. Future cash inflows are there. Present value of future cash inflows is there. Present value of future cash inflows total sum of this is 700. This is the initial investment. What are they said? What is this? This says, they said present value of future cash inflows of the project. This is 700. No, is lower. What is the lower? Present value of future cash inflows is there. Is lower. This is lower than. Okay, then its initial investment is correct. Present value of future cash inflows are lower. Why? Lower than initial investment. Yes, initial investment is 1000. Future cash inflows present value is 700. This is correct. This is lower. Okay. Therefore, we can agree with this statement. A is correct. If the annual net cash inflows of the project is increased, annual net cash inflows means, what is its meaning? Annual net cash inflows means estimated net cash inflows annual means this one. Okay, this one. Annual net cash inflows is not a percentage. No, net cash inflows is there. Is increased to 250. The annual net cash inflows currently 200, no? This is increased to 250 for each year. 250 for each year. 250 annually. Okay, this is changing. Here it's 250. That's increasing assumption. Its payback period is 4 years. How can we calculate payback period? Is how can we cover the initial investment newly 250s? Therefore, we can calculate 1000. Look here. There is 1000. No? There is 1000 is initial investment. Firstly, 250 covered. 1 year is over. Another 200. There is 750 is remaining. Another 250 was covers. Why? The annual cash inflows are 250 all years. Therefore, there are this is a 2 years already done. There are 500 remaining. Therefore 250 again minus. There is 3 years are done. 3 years are done. Done. Another 250 is remaining. 250 inflow is 400. 1000 divided in 250, we can easily find 400. The payback period is we must collect cash inflows 4 years for cover the initial investment. Therefore 4 years payback period is correct. 4 years payback period is correct. Yes. Okay, next one. When the expected rate of return of the project, expected rate of return means interest expense, no? Interest expense was when the expected rate of return of the project is higher than 10%. Higher than 10% means there are 12%, there is a 15%, there is a 20%. Okay, its NPV is positive. Is that correct? No. Net present value is decreasing. Why? The interest rate is increasing. The net present value, the present value of the goods, present value of the goods and services was decreasing. Why? I said you. Look here. This is the statement. No. This is the discount factors. No. Discount factors on 10%. 10% interest rate or in expected rate of return. At that point, this is the expected rate of return is 10%. Expected rate of return is 10%. Based on the 10%, the discount factors is there. Discount factors is there. This is the years, no? 3, 4, 5. Discount factors are 9%, 8%, 7%, 6% and 5%. Discount factors. You know these discount factors identified through this 10% discount rate. How can we calculate this one? Look here, what are the meaning of that? This is the meaning. Okay, this is the 1 rupee coin. This is the coin we can purchase after 1 year 0.9 toffee. Okay, this is a 1 rupee coin. This is the 1 rupee coin. After 2 years we can purchase 0.9 toffee. Okay, what is the meaning? Look here, 0 year and first year I calculate. Look here, 0 year there is a 1 discount factor. This is a discount factor. No? Discount factor is 1 at the 1 year 0.9. Okay, this meaning is look here, this is a toffee. No, this is a toffee. No, this is the toffee, 1 toffee. This is the coin. No, this is the coin. This is the coin. This is the coin. This is the toffee. toffee. Look here the story. Look here the story. 0 means currently I go to the shop and he give the 1 rupee coin. I request the toffee. He give me a 1 toffee, full 1 toffee. Okay, why? The toffee value is 1 rupee. Okay, after 1 year, this is the year 1, this is the year 1, this is year 0, this is the year 1. Year 1, after 1 year, I go to this shop and give him another coin. Please give me a toffee. But he give me the half of that. Look here, 0.9 toffee. He deduct the toffee quantity. Quantity means the count. The toffee is, they give me 0.9. Actually, how can we calculate this? This is the 0.9 toffee is the deducting. After 3 years, this is year 3 now. Year 3, 0.8. 1 rupee coin is give to the seller and he give me the 0.8 toffee. This is another deduction of toffee. Okay, this is how can we calculate the 0.9. Actually the seller don't give the 0.9 toffee, 0.8 toffee. They give a full toffee. How? At the year 1, I give him a coin, 1 rupee coin. I purchased full toffee, full 1 toffee. Okay, after that I want to purchase a one toffee. This is the toffee, but the toffee price is increasing in 10%. 10% means expected rate of return. The seller want to pay the interest 10%. Therefore, after 1 year, he add to 1 rupee 10% interest. 1 rupee to 10% interest. Therefore, this formula is calculated as 1 toffee dividing into 1.1. Why? To purchase 1 toffee, I give him to 1 rupee and 10 cents. Why? The 10 cent is interest. Interest means expected rate of return. Okay, therefore please 1 divided in 1.1, answer is 0.9. 0.9 is there. Okay, 0.9 is there. This is the meaning of the discount factors. You know, think about the interest rate is higher. This current is 10%. This increase 12%, 10%, 20%. Like at that point, you can think these discount factors are decreasing. Why? This toffee after 1 year, the toffee quantity is toffee weight is decreasing. Why? The price of the toffee is increasing by 10%. After 1 year, look here, this is 20%. Think no, 20% to 1 year. After 1 to purchase 1 toffee, the expected rate of return is 1 rupee to 20%. No, 20% no. At that point, to 1 rupee, he add interest of 20% as 20 cents. Therefore, 1 divided in 1.2. Please divide this. We can find the answer. Answer is decreasing. Why? Look here. Please use the calculator. Look here. This is the 1 toffee. To purchase, we give the 1.2 rupees for purchase 1 rupee. Therefore, I divide 1 in 1.2. Answer is, look here, 0.83. The current situation 0.9. No. After 1 year, the expected rate of return is increasing. The purchasing purchasing capacity of the expected rate of return was increasing. After that, discount factors are decreasing. Discount factors means number of toffees. Therefore, the expected rate of return is decreasing. The interest rate, no? Expected rate of return means interest rate. Interest rate is increasing. There is a discount factors are decreasing. After the discount factors are decreasing, these discount factors are decreasing. What is the result? Multiplied by 100 or cash inflows. This discount factors are said the NPV. NPV means toffee value. Okay, these discount factors are decreasing based on the expected rate of return are increasing. Okay, expected rate of return means interest rate. Interest rate is increasing. We cannot purchase number of toffees using these discount factors. Discount factors are decreasing. Based on that, there are number of toffees are decreasing. Number of toffees are meaning in net present value. Net present value is decreasing. Look here, I flow you again. This is the expected rate of return. Expected rate of return meaning is interest rate. The interest rate is increasing. What is the result? The expected rate of return is increasing is same to interest rate is increasing. Interest rate is increasing. Discount factor should be decreasing. Why? Interest is increasing. Discount factors, number of toffees are decreasing. Discount factors are decreasing. Discount factors are decreasing. What is the meaning of discount factors? Are number of toffees decreasing. Why? Interest is increasing. There is inflation, no? At that point, discount factors are decreasing. Discount factors are same to toffee. Sorry. Number of toffees are decreasing. Number of toffees are same to which amount? Number of toffees are net present value. Net present value is number of toffees. Number of toffees are discount factors. Okay, there is a same impact to this one. Expected rate of return is increasing. Impact to interest rate. Interest rate is increasing. Interest rate is increasing. There is inflation. There is a goods and services prices are increasing. Therefore, discount factors are decreasing. Discount factors means number of toffees. Toffees are decreasing. Why? We cannot purchase number of toffees. Therefore, net present value is same to toffees. Therefore, NPV was deducting. Therefore, their statement is wrong. Why? They said increase, no? Look here. If the annual net cash inflows of the project is increasing, okay? Sorry, when the expected rate of return of the project higher means interest rate is increasing than 10% is 20%, no? Okay, NPV was positive, no, NPV should be negative. Why? Currently NPV was negative. Look here, currently net present value is negative. Look here, currently NPV value is negative, minus at 10%. After the increase in the interest rate, this should be again decrease. Why? We cannot purchase toffees. At the 10%, we cannot purchase toffees. There is a minus toffees. After the increase in the expected rate of return, interest rate should be increased. Interest should be increased means inflation. There is inflation, we cannot get toffees. Toffees means net present value, cannot means toffees is decreasing again. Okay, Therefore, we cannot agree with this statement. There is a crucial explanation why this is the major point. This is wrong. Therefore, A and B is correct. Answer is 2 for question number 30. Okay, in next video we meet the easy one, introduction to accounting. Okay, in next video we meet question number 31.